Good afternoon and welcome to our Saturday session at Happy Investor. I'm Sujata and I shall take you through today through some basic questions that some of our clients have shared with us. And those of you who have logged in are also free to raise a question that you would like answered during the session. We'll wait for a couple of minutes. We are still getting some registered participants logging in. So give me 2 minutes to start. Good morning, participants, and we shall now go through some basic questions that a lot of mutual fund investors have. And some of them have shared those questions with us in advance. And I shall first go through those questions that we've received. And then we can have an open session on questions that you would like answered. So mutual funds are subject to market risk. This is all something that we have all heard. And a lot of misconceptions exist based on that. And there are certain questions that are always there in the mind of. One of such questions is, which type of mutual funds are better for retirement planning, equity or hybrid? This is a very basic question. A lot of people accumulating money for their future have, and we'll have these answers today. So retirement planning actually can start at different times in your life. And based on when you start, you should have a different set of funds in your portfolio towards retirement plan. So if you start contributing towards your retirement plan in your 30s, then that entire basket should be in equities because you need long-term growth. If you start contributing towards it in your 40s, you should be higher in equities, but you should also have some hybrid funds. If you start contributing towards your retirement only in your 50s, then you should be equally in equities and hybrid. Because this combination of equity and hybrid actually helps to manage your risk level based on the timeline that you have before you have to start using those funds. So as you near retirement, which is at your choice of time, whether it's at your age of 55 or 58 or 60, as you near those retirement years, you should also include debt mutual funds for more security. Because once you retire, you will start withdrawing from those baskets. And therefore, you should have a certain amount accumulated in debt mutual funds, which are more safer and less volatile. These are some basic differences between equity, hybrid, and their suitability for retirement planning. If you wish to look at a more detailed understanding of how to plan for your retirement, we have a retirement planner on our website, the address of which you can see here. And I shall just show you how this works. You could visit our website and put in certain details on your own. So this is our retirement calculation. So basically, what you do for a retirement calculation is very individual specific. It depends on your current age. Say for someone who's 45 and would like to retire at age 55, and how much you would need at your retirement basically depends on how much is your current monthly household expenses. Because once you retire, you should be able to lead a lifestyle similar to what you're leading today, minus, of course, the expenses related to your work or related to your children, because at that point, that would not be on you. So suppose you have a monthly expense of, say, 50,000 rupees towards all your household responsibilities, utilities, anything that is spent on a regular basis. Then you put in those details and then you calculate. So this is calculating how much you would need to spend on a monthly basis over the next 10 years. So today, if you're spending 50,000, you'd spend about 1 lakh 10 years later. To be able to spend that kind of money every month for the next 25-30 years of your life, you should have a corpus of about 3.25 crores. And to reach that corpus from today, you need to start adding about 1,40,000 rupees per month. So this gives you an understanding of what you need to do to ensure that you know how much you need in the future. But to plan this better, you need the guidance of someone who understands where this should go. So if you are looking for something like this, you can reach out to us, do a basic check for yourself on our retirement calculator page, and then you can reach out to us for further guidance. I shall now go back to our portfolio, our presentation. Another question received from Anita Rao, who's 30, from Bangalore, who has said that I have been investing 15,000 per month in SIPs for the last 3 years. Am I on track to build a retirement corpus of 2 crores? Now, what we understand from this question is she's putting aside a certain amount of money for the last 3 years, but she's unsure of where this is going and whether she'll be able to create a corpus of 2 crores. Now, a retirement corpus, like I explained earlier, the need varies from everyone based on their current age and their lifestyle. So first thing we need to figure out is whether 2 crore is the corpus that Anita needs 20 years down the line or 25 years down the line. How much should you contribute and where depends on how many years she has to build this corpus. Now, is she going to be working for 20 years or 25 years? We don't know. And therefore, we go back to our retirement calculator, which will help you to answer these questions. So Anita is 30. We don't know when she'd like to retire and what is her current expense. So unless we understand what is her goal, it's not easy to say whether 15,000 per month is enough for me for a retirement. So do visit our website and calculate what is the requirement that you will need. Another question from Rajesh Mehta, Pune. Markets have been very volatile lately. Should I continue my SIPs or should I pause them until things stabilize? This is a typical question that comes from a lot of investors. It rises in their mind the moment there is some kind of ups and downs in the market. So when markets go up and down, you should continue your SIPs as these are meant for long-term growth. In fact, when markets are down, you should also try to add more or increase your SIP if it's possible. Because when markets go down, it's actually similar to a discount sale. And your regular SIP of the same value will pick more units at a lower price. And then when the market stabilizes further, you generate better return for the amount that you have contributed during that down phase. So definitely you should continue your SIPs and not pause anything for the moment. The next question is from Meena Sharma of Chennai. How can mutual funds help me plan for my daughter's higher education abroad in the next 8 years? Yes, a lot of parents today are in that requirement phase where they need to start setting aside money for their children's higher education. So what should you do? So you need to first estimate when you would need that amount. For example, at the child's age of 18, 21, 22 for a PG. So Meena says she needs this money in 8 years. Then you need to get an idea of what is the cost, the proposed education that your child would like to pursue. What's the current cost? So for example, if Meena's daughter wants to study 8 years later, what is the kind of education Meena is planning to get for her? And what is the current cost? And then we need to estimate what would be the future cost. So if today a degree abroad costs, say 50 lakh, then we need to estimate 8 years later, what would be the cost? And how much would I need 8 years down the line? And then once you fix that number, We can then figure out how much I need to start adding now so that in 8 years, it will generate the corpus I need. And then we need to also figure out what should be the choice of mutual fund to put into that basket based on the timeline, based on your risk appetite, etc. So those are things that a mutual fund distributor can act like Happy Investor can actually give you guidance for. We also, like the retirement calculator that I earlier explained, we also have an education calculator on our website where you input your child's age currently, the age at when they want to opt for higher education, and what is the cost of that higher education today. And then when you run the calculate, it will give you what would be the future cost. And for the time that you have, what is the monthly investment that you need to make so that 8 or 10 years down the line, when you actually need the money, it will be available for you. So you can reach out to our education calculator on our website and put in a query on your own and see where this goes. Like, for example, Meena said she needs this 8 years down the line. So say she's 10 today, her daughter will be 18 in 8 years. And since she said an overseas education, I am putting an estimate of say 50 lakhs just to show you how the calculator works. And then you calculate what would be the future cost. The future cost would be about 1 crore plus. And for the 8 years that Meena has, she'll need to contribute about 66,000 plus per month over the next 8 years to generate that one. Now, which funds, how much in which funds, that's something you would need someone like Happy Investor to help you to plan. Sandeep Kulkarni from Hyderabad says, I keep hearing about equity, debt, and hybrid funds. How are these different and what are they meant? So yes, though broadly we hear mutual funds are subject to market risk, there are different types of mutual funds. Like Sandeep has asked, there's debt, there's equity, and there's hybrid. And these are combination of different types. And each type is better suited for different purposes. The debt mutual funds are low risk, where the principal amount that you put in is safe, and it will give you returns a little better than FD rate and are better suited for a shorter period where you plan to use the funds within 2 to 3 years, or where you have parked it for your emergency fund. So these funds lend out the money that you have invested to people who need loan, just like how a bank lends out the money that you have put in a fixed deposit to somebody else who needs, say, a home loan. But here, debt mutual funds usually loan this out to other business institutions and not to individual people. So there, the growth that you get is always a little better than the FD rates that the banks give. Then we have equity mutual funds, which are high risk and they invest in the stock market. So in the short term, the value of your invested amount could go negative, or the value of your portfolio could go down and up in different phases. But in the long term, these funds generate higher return and grow your investments to create wealth. So these kind of equity mutual funds should be considered only if you are willing to keep the amount invested for more than 5 years at a minimum. The longer you hold them, the better the return. But yet, in between, they can get negative in value or lower in value than they were at any point in time. When we say hybrid mutual funds, these are a combination of the above two, which is equity and debt. So they invest in low risk debt as well as high risk equity and are good if you are willing to stay invested for more than 3 years. Say a requirement where you're planning to use the money between 3 to 5 years, this is a good option. These are less risky than than full equity, but they have slightly higher risk than debt. Someone told me, said Kavita Nair of Delhi, that mutual funds are more tax friendly than other investment options. Is this true? Yes, this is true. You do not pay. Why is this more tax friendly? Because you do not pay tax on the growth that your mutual funds generate till you actually take out the money for your purpose of use. So different type of mutual funds are taxed differently, and also this varies based on the time of the investment. Have you held it for 1 year? Have you held it for 3 years? Have you held it for longer? They are not all taxed like the interest on your fixed deposit. Because interest on your fixed deposits or interest on any kind of bank deposits or corporate deposits, they are all taxed at your income slab rate. So if you fall in the highest income slab rate, which is 30%, and then if you are above 50 lakhs, then you get into the surcharge, then this interest component is taxed at that highest slab. And also, since mutual funds are pooled investments, where everyone adds into the kitty, you benefit from the market growth till such time that you do not withdraw. Even if you are not adding money in between, because multiple investors are adding money, you benefit from that market growth even then. And at withdrawal, there are some exemptions. And also, the tax rates on this capital gain is much lower than what you pay on interest. For example, when you withdraw money, at the end, if you withdraw money from equity mutual funds, then you have a tax exemption on profit of about 1,25,000. And the tax on profit above that is only fixed at 12.5%, unless your top slab of 30% on any other kind of interest. So yes, mutual funds are tax friendly. So how often should I review and rebalance my mutual fund portfolio is what Arun Menon of Bangalore wants to do. Usually, one should review the portfolio on an annual basis and check if your allocation across different asset classes and schemes are well distributed. Like we said, a mutual fund portfolio is not one basket. It is a large basket which has smaller baskets in which you will have monies of different amount distributed. So one should understand whether this distribution has been good. Has it worked? Is it what I need based on my requirements? And is it what suits me? So that kind of allocation across different classes and different schemes needs to be checked on an annual basis. Reset if required. You also need to see how the funds are performing as per the market and their peers. So we are all invested in the Indian stock market. So we have certain measures in terms of how that markets perform. So we have an index, we have a ETF, we have certain parameters to measure the movement of the market. So have your funds stayed within that bracket of the market movement? Have they performed similar to others in the same category? So if you are looking at a large cap fund in your portfolio, how has that large cap fund performed vis-a-vis other large cap funds and vis-a-vis the broad market? So these are some things that you need to check. And then you have to see if there are any underperforming funds. Then you need to see if there's something wrong. And unless there's something very fundamentally wrong with the fund, it's not necessary to change. It just could be a cycle that the fund is going through. And when that cycle changes, it will reset. For example, a batsman who's out of form might not perform for a couple of matches, But if he is a batsman with a good pedigree and good technique, in a couple of matches, that whole thing could change. So it's not necessary that the team drops that bat. Similarly with your mutual fund portfolio. And you should also check whether your portfolio needs any changes based on your requirements, based on any personal changes in your life, your financial position, and immediate and future requirements. Priya Deshpande from Mumbai asks, can NRIs also invest in mutual funds through Happy Investor? And what are the key things that they should keep in mind? Yes, NRIs can invest in mutual funds, and we at Happy Investor will be able to help you to invest in mutual funds in India. There are some rules that have to be followed based on your country of residence. Like if you are an NRI in the Gulf states, or you are based in the US as a tax-paying resident, or whether you're in Canada. There are certain rules and regulations that have to be followed based on that, and it will differ from investor to investor based on the location. And we will be able to guide you on those rules. Taxation on the profits will be based on India taxation rules for now, where it means that your capital gains will be subject to tax deduction at source. You will get a tax credit for the same, and this can be adjusted with your tax payable in your country of residence. Yes, there has been a lot of talk about the fact that as an NRI, you need not pay tax on your capital gains invested in India. But for that, there are certain rules and regulations that the investor will have to follow in advance while making the investment and on it regularly on an annual basis. And we will be able to guide you on that as well. We are now open to taking questions from the audience. So you could unmute yourself and ask any specific question in case it hasn't been answered in the questions that I have just taken you through.
Sujata, where is the retirement calculator which you show in the website? I didn't find it.
You can also find it on the footer of the website. As you scroll down the home page, you'll be able to see it at the bottom.
Mm-hmm.
You'll also find the education calculator there.
Hi, Sujata.
Yes, Tilaka.
So, do you suggest in the portfolio we have some old funds? Okay. Do you think now the market is little going slow? Can we remove that and put it into a different basket?
When you're talking about old investments, old funds? What are you specifically referring to?
Yes. The old funds we have in our basket.
No, when you're saying old funds,
yeah,
what do you mean by that?
Which means it's like from long term, and it has a good money. So should we remove it out and put it in a different basket because the market is low? It will help anything?
That's what I meant over here when we say that you need to review your portfolio once a year.
Okay.
I had mentioned there that you need to you should review it once in a year.
Okay.
You need to see how they are performing as per the market and their peers. So now if you have a large cap fund, you have to see for how long you have stayed invested in it. And during the time that you have stayed invested in that large cap fund, how has the large cap segment fared?
Okay.
Now, if it has been doing well, then there is no need to change it.
Okay.
Also, you need to check, like I said, you need to check your allocation across different asset classes.
Okay.
So are you there in the large cap? Are you there in the mid cap? Are you there in the small cap? Of course, how much you should be in each of these depends on your risk profile and the timeline of your investment. So ideally, these are decisions that your mutual fund distributor who is managing your portfolio should be taking and will reach out to you to make those changes if they are necessary. Like, for example, I also said it's not necessary to change funds unless there's something fundamentally wrong.
Okay. So, one more thing is like if we have freezed for some time, not invested, if we do a lump sum, how do you suggest us to invest in one go? Like the well performing mutual funds, which is already in our basket, or a different allocation?
So if you've not added money for a while, that's fine because a lot of times there are changes that happen in our plans. And then you might have a certain amount of lump sum to add. So at that point, we need to look again, we need to look at your allocation across different asset classes, which is always the primary decision-making point. So it's like when you sit for a meal, you should have rice of a particular proportion, dal, sabji, pickle, sweet, whatever. So you need to see whether your allocation across these different asset classes, where does it stand? Where is it less? Where is it more? And then that the fresh amount can be added accordingly to balance that. And also at that point, when the money is coming in, we need to see where is the next set of growth going to come from for the next 2 or 3 years. And then you could shore up the allocation higher in that category.
Got it.
So you just now said that every end of the year you have to look at your portfolio and assess how is it doing and all. Now, what is the benchmark that how do I derive that my portfolio is really doing very well? On what basis?
Right. So this is what your person who's managing your funds should do. Because when you are a person who's handling this kind of investment, there are certain benchmarks that one has from data that is available from the fund performance. For example, at Happy Investor, we do this by benchmarking your portfolio performance with the market performance. And we benchmark the performance of your fund with the market peers. So if you are invested in ABC large cap fund, then we will look at how that ABC large cap fund has done vis-a-vis large cap fund X, Y, Z, because there are multiple large cap funds. So we will see whether the fund that we are invested in for you has kept track of how the market has performed and how the peers in that segment have performed. Now, if there is something that's not gone as per our expectation, then we dig into the fund to see what is happening. And this is not done only once in a year within your portfolio from outside. This happens on a quarterly basis internally. And if we feel that there is a necessity to reset, then we reach out to you. So this is something that is to be done technically with a lot of background information, which is why we always say that, just why people say when you go to the doctor, you go to a dentist, you go to a specialist, all that is fine. But when it comes to your investments, people feel, no, it's fine. I can do it on my own. I have suggestions from my friends, from my family, and from the media and publications, and I can manage it myself. But yes, there is a lot of other things that happen within the black box so that we can ensure your portfolio is delivering as per expectation.
Yeah, that's one of the reasons why we are invested with you.
Thank you. Thank you for being there with us this Saturday, and we hope you have a nice weekend. And we'll catch up soon with another session in the coming weeks.